Oh, look, the market open. Red again, you son of a piece of shit. What the? Another day in the market. So let's take a look at the Nasdaq composite right now. That's what I've been following because it seems really like cryptocurrency's following the Nasdaq and moving along with it. And it's also kind of a good judge of the market because tech stocks have been having a lot of problems. Okay, you see we have a support line here on the Nasdaq, roughly 14,522. So we keep seeing it bounce off of this. If you go back in history, this is a big point for the Nasdaq. It's either going to bounce here or it's going to go all the way down here to about 14,185. So we're really just watching it to see what the pattern looks like. I mean, it kind of looks similar to this pattern where it bounced before, but it also kind of looks similar to the pattern that went down. So we'll have to see in the next couple of days. Right now, it's probably best to hedge against the market just in case. If you bought some options, some put options against the Nasdaq, or found a inverse ETF against the Nasdaq, that's probably your best bet just to hedge. Maybe make a little money if it does go down further. If it goes up, you lose a couple bucks, but it's really just a hedge against the market. Maybe buy a put option in the QQQ, or you can buy a call option, or just put some money into the SQQQ. That'll kind of protect you. If it does go down, you'll make a few bucks. If the market does go up, maybe you'll lose a few bucks. It's really just hedging to make sure the market doesn't fall out from under us. I don't think it's going to, but listen, I'm not a financial advisor. Nothing I say is a suggestion to buy, sell, or trade any stocks. I'm just giving you my opinion. And the truth is the market's crazy right now. We can go based on the charts and have a best idea of what's going to happen, but the true story is it could go either way. The market at any point in time could always go up or it could go down. It's always going to be like that. Nothing's guaranteed. Nothing's 100%. No matter how great the chart looks, nothing's 100%. No one can call the stock market. If they could, they'd have $1 trillion in their bank account because they'd be right every time. It's just not going to happen. It's really just our best guess. Go by the charts and try to figure it out together and see where the market's going to go. And if you go by the charts and you go by what's most likely, you're going to be right more times than you're wrong, and you're going to make money. The whole goal is to be right more times than you're wrong, but you're going to be wrong. Everybody's going to be wrong. Everybody on YouTube is going to be wrong at some point, probably 30, 40% of the time. The point is just to be right more often than not. And that's all we're looking for here. So if you look at the charts, something that I did find that's pretty interesting is it seems like the IXIC, the Nasdaq Composite Index, does kind of judge when we're going to have a really big pullback or a recession. And I kind of use those words interchangeably because sometimes they're pretty similar. A recession's technically if you have lowering GDP for 2 quarters. But I mean, if the market drops 40% and they don't call it recession, it's still kind of a recession, right? But if you look at this chart, I can show you when I think that you can generally call a recession. So it seems that every time the IXIC goes below the 200-day moving average or touches the 200-day moving average twice, then we generally have a recession pretty quickly. And I actually drew out my couple of options of when I think that we could go into a recession or have a really big pullback. And this is based off information all the way back from the dot-com bubble in 2000. When you take that much information into consideration, sometimes it's going to be differing. Every time had different factors around when it happened. So this is multiple options of what I think might happen based on that information. So one option is it follows this yellow line. We go up in the market for a little while. We go down a little bit. We go up a lot. And the market generally goes into recession when we're at a peak. So I think we're going to hit a peak at some point and then fall down here. There's that option. Or like you see with the blue lines, it's going to go somewhere around here and then fall off. Now, this is around June 18th, June 17th, June 18th. The Fed has a meeting where they're probably going to raise rates again around the 14th or 15th of June. So I think this blue line is probably the most likely to happen. And, it's possible, like I said, we go through the yellow line, but that's the market going up a lot. And I think we're going to go up a lot, but I think with all the fear and problems and them raising the rates, I think this is probably a very good option on this blue line. But it could go either way. So like I said, I think it's either going to follow this yellow line here, or we're just going to go straight up and then straight down. We might not curve around. So, I mean, generally speaking, you see with the stock market, it always bounces around a little bit. But we're talking about big moves. between these moves, between these stars, you're going to have some up and downs, and some good days, some bad days. But generally speaking, I think it's going to follow one of these sets of predictions. And they're kind of the same. The only difference really is the length of time, and if the market goes up and down back a little bit and then up again, or if it's just straight up and straight down. It really could go either way. It's really hard to tell because, there's a lot of millennials right now in the market. There's new traders. They handle things differently. It's a different time. Tech's different than it was when you go back to the dot-com bubble. A lot of things have changed. But this is just a general idea of what happened. And this gives me an outline to follow. So if the market does go up to here and it starts dipping a lot, maybe that's a sign for me to get out. Or if it does go past this and it keeps going all the way up here, then maybe I know that's when I need to look for an exit. I think everybody should have their own idea of what's going to happen. Not only can you look back at it and test yourself and say, well, this is what happened, this is where I was right and wrong, and you can learn from that, you can at least have something to follow and have some idea. Because you have to have a plan. You can't just wing it the whole way and then the market's going to fall off from under and you had no idea when it was coming. You have to have some general idea based on history of what you think is going to happen. So this is my idea based on history of what I think is going to happen. So having said that, if you go back and look, like I was saying, anytime the market comes out of a recovery from a previous fall, generally the Nasdaq will go touch the 200-day moving average twice before it goes into a recession or a major pullback. So this was back in June of 2019, and it always seems to have a false start when it comes out from a recession or a giant pullback. So you see I put an X next to those arrows. Generally within a few months, it goes back down to the 200-day moving average. So I put an X next to those. After that point, it usually comes down and touches the 200-day moving average twice. Once it hits twice, it's pretty much a given that it's going to fall off the face of the earth. So you see false start, touch the 200-day moving average, touch the 200-day moving average, went up a little bit and then fell off. So let's go to what happened before that. So now we're all the way back to 2018. So you see it came close to the 200-day moving average several times, but it didn't quite touch. And then here, right when it fell off, it actually went under the 200-day moving average once, back up. And I think that the thing to look for here is when it goes under the 200-day moving average more than a week apart. So not in the same trading week. I think sometimes it does go up and down under the 200-day moving average in 1 week, but this is generally speaking two different weeks, 2 different trading weeks. So you see it went under the 200-day moving average, back up, under the 200-day moving average, and never came back up. We can go back further than that. So you can see this is December 2012. You had a false start, and then it came up, touched the 200-day moving average, touched the 200-day moving average, and then the next time that it came down from a peak and touched the 200-day moving average, it went through it and never came back. Let's see what else we got. Obviously, some pullbacks are bigger than others, so they're better examples. But generally speaking, this is a trend that's for pretty much every pullback that the Nasdaq has. And the Nasdaq's, a good judge of the market. We're very heavily invested in tech stocks. So now we're back to 06, 08, that area when we had the housing market crash. So you see when it came out of the recovery, it had a false start, and then it went under the 200-day moving average twice. It went up some, and then it fell off the face of the earth after that. It just goes down and down and down and down. It never makes it over the 200-day moving average again. It keeps getting kicked back and bounced off the bottom. So I think that's the pattern that we're looking for here. At least that's what I'm looking for. So if we take that all the way back to where we are today, let's take a look at the chart and see where we're at and what that means for us. So we've been on a run since basically April of 2020. So you can say this might have been a false start, but it's kind of hard to judge. But I think it's been long enough now to say that this is probably our first dip under the 200-day moving average. So we're probably going to have one more dip under the 200-day. So we could go up and then back down and dip for a second time and then go up again. Or we could just go all the way up from here. And the next time we dip under the 200-day moving average is when the stock market's falling off a cliff. So there's really no way to tell. Time will tell. And you can, for me anyhow, this is what I'm going to follow and try to go by and look for patterns, because the market usually works in patterns. Sometimes it creates a new pattern, but generally it keeps following the same pattern for a long time. I've been saying from the videos from before is the Nasdaq and cryptocurrency are pretty well connected to each other. They're following each other. And if you look at Ethereum, Ethereum never really hit this mark that it was supposed to hit. Generally, before it always goes for another run, it always comes back to this orange line. So I think something's going to happen. Maybe we have a couple not so good days just so Ethereum can get back here. It has to hit around 2,897, 2,900, somewhere in there. It has to come back and touch this line before it goes up. Now, it's not 100%. Like I said, nothing's 100%. But generally speaking, it's always come back to this line, and it's really close. So I think it's going to fall enough to hit this line and then start going back up. And for that to happen, the Nasdaq can't be on a run because it has to be down with Ethereum. And maybe crypto's not going to follow the Nasdaq for a long time, but for the time being, it is. So we kind of have to go with what's happening now and go by the charts and at least try to follow some patterns. So I think it's going to come down more and hit this line. And then I think after Ethereum and even Bitcoin hit these lines that they always pull back to, once they hit this orange line, I think it's pretty much up from there. I think finally the Nasdaq and the Dow are going to snap out of it and they're going to be up and up. If you look at the Dow Jones today, it keeps pulling back to this line. So I don't know how much lower it's going to go. It might go all the way down to the 200-day moving average itself. But you see it keeps kind of magnetically being pulled back to this resistance line, the diagonal resistance line. So we're going to keep an eye on that and see what happens. But I really think if it falls below that, the 200-day moving average is a really big resistance line for anything. For the indexes, for stocks, for crypto, whatever the moving average is, 150-day, 200-day moving averages, you should keep an eye on things like that because they are really big resistance lines. That's it for the market recap for today and what I think is going to happen in the next couple of months. But I'm basically not going to get scared. Where everybody's fearing and selling right now is the time that I'm going to be buying. I want to buy these stocks at their lows, invest in good stocks that have a lot of growth, that have shown they've had growth in the past, and they have a lot of movement, that this isn't their natural low. You know, we're trying to buy stocks that are on their 52 weeks low or their new 52-week low. A lot of these stocks are down 40, 50%. That's the stocks I'm looking to buy. Thanks for joining me again today. I'll make another video in the next couple days and we'll see where we're at. Good luck trading.